My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll do my friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CBC. Tweet me at Jim Cramer. Look, you can't blame anyone for missing this spectacular rally that started 10 days ago.
That was easy.
They know nothing! It took us all by surprise. Almost everybody. But after a day like today, when the Dow gained 555 points, S&P jumped 1.61%, and the Nasdaq scorched 2.34% higher, you know what? It's worth thinking back to what happened in the Monday meltdown 2 weeks ago, just to get a little much-needed perspective. Now, I don't want to just rehash the turn. You don't need this weatherman to know which way the wind blows. Instead, here's what I want to do. I want to talk to you about the obstacles to catching a tradable bottom, because they are incredibly powerful. At the lows 2 weeks ago, everybody wanted to sell. Not buy. Even though, in retrospect, it was a tremendous opportunity to purchase some high-quality stocks at bargain basement prices. Now, it all starts with an initial decline that took people by surprise, and then it reverberated through the stock market. On that Monday, 2 weeks ago, we saw the Dow fall 2.6%, S&P lose 3%, and the Nasdaq nosedive 3.43%. It was a horrible, dispiriting session. Why did it happen? All right, the explanation was very mysterious. We were told that the yen carry trade broke up, and apparently that's a massive and lasting problem, right? Sometimes, just to see how bad it is, it pays to look at the next day's summary in the Wall Street Journal, because it's the most authoritative real-time account of all the pain and fear people experience. Under the headline, and I quote, "Unraveling Trade's Fuel Market Rout," we read, quote, "The unwinding of some of Wall Street's most popular trades intensified Monday, sending Japanese stocks to their worst day since the 1987 market crash and walloping U.S. technology shares." For the vast majority of home gamers, and a goodly number of professionals, this excuse sounded ominous. Popular trade, must have been hundreds of money managers involved. A mention of the devastating 87 crash, where Japan's meltdown heralded our own horrific collapse. When they say tech was the focus, doesn't that mean the Magnificent Seven are done again? Somehow, they must relate to this mysterious yen carry thing that helped send the Nikkei down an astounding 12% that day. Many thought there'd be some inevitable contagion. On top of that, we discovered that the smartest investor in the world, Warren Buffett, was selling tens of billions of dollars worth of stocks, including a lot of Bank of America, a long-time holding, and Apple, a stock he said he wanted to hold on to as recently as last month. So we have the best of the best investors lightening up while the averages collapse. It made you feel like an idiot for buying stocks or even owning them. If Buffett's blowing out of Bank of America, didn't you have to sell the banks, even though Bank of America had the best quarter of the majors, right? If he's selling Apple, I mean, he must know something's wrong, right? I mean, he knows everything. So why don't we just shoot the stock first and ask questions later? It's only natural, right? The yen carry trade implosion, Buffett blowout, then you know what that is? A 1-2 punch. But if we parse these negatives, we discover something that is so different that it's almost embarrassing. In the end, these turned out to be incredibly flimsy reasons to sell. Alibis for dumping stocks sound very convincing when the averages are getting crushed, don't they? But you need to put them to the test, or else they'll lead you in the wrong direction. They often do. For example, the carry trade. All right, now that's just probably when everybody goes, whoosh, carry trade. That's genuine Wall Street gibberish for borrowing money. The fund managers who were borrowing money were borrowing it in yen because Japan has some of the lowest interest rates in the world. But when the Bank of Japan suddenly raised rates a couple of times, the yen spiked and the cost of borrowing money in Japan soared. Just think of it like this. They have an adjustable rate mortgage. You take it down to 3%. Suddenly it goes higher like that. Maybe to the point where you can't afford the house anymore. In short, The institutions that were borrowing yen, and they weren't that many, it wasn't hundreds, the ones that were borrowing yen suddenly had to raise money immediately, which is why they sold practically every stock under the sun, including our great stocks. Yes, it was a popular trade, which meant there were a lot of forced sellers. That was a huge part of why the market got crushed. Too many complacent portfolio managers borrowed too much money, thought they were really smart. They turned out to be dumb. They're hiding right now. We won't know who they are, or I would put every single one of them on the wall of shame right behind me. Pretty simple. More importantly, it was never a long-lasting problem. It was a one-off, even though the papers made it sound like it was going to be with us forever. The other pillar of pain, Warren Buffett selling Bank of America and Apple. All right, Buffett's the best there is, so he's the best there is. So people looking at his moves and end up extrapolating to the point of absurdity. And that's why they dumped the banks. It's why they dumped Apple. We heard it was based on Apple's supposedly weaker Chinese sales, yet CEO Tim Cook told me just a week before that the sales were surprisingly strong, and I detailed why that was. For the rest of the week, until we got a positive jobless claims number Thursday morning, we labored under the delusion that our economy was headed for a recession, potentially a worldwide recession, all because of Japan. And the safest thing to do was to sell. It didn't matter that Japan only bounced back 10% the next day. What mattered was the smart money was getting out of the whole asset class, and we felt like dopes hanging on. In reality, it was the dumb money that was getting out, in part because Warren Buffett or one of his assistants made us nervous. Of course, we knew nothing about why he sold. Maybe he was just ringing the register. Big gains. Nobody cared. It just made everything more fraught, more fearful. And, of course, just so we know, Japan, I mean, who knows? There was absolutely no contagion. Now, let's take a step back. There are two parts to every sell-off. The averages get crushed when you have a wave of sellers like these knuckleheads with the yen money. And then the other part of it, though, is a lack of real buyers. We knew who the sellers were, these troubled money managers, and we thought we knew their motivations. But if you wanted to do something, if you wanted to buy, you ran into a real problem. It is earnings season, and it's a big one. And while you might hear that it's going well, we actually lack a series of big beat and raise quarters. We got a lot of such surprises when management left their full-year forecast unchanged, which is basically an implicit guide down. So very few stocks seem like enticing buys at that moment. Even though the selling turned out to be based on pretty much nothing, hardly anything looked like it was pounceable, so to speak, like you wanted to buy it on the dip. When I scanned the earnings report from this season, few companies actually beat and raised. Let me tick them down for impact, write them down. First, we had two tech companies, that's right, only two, that gave you fantastic sales, earnings, and forecasts. That's the magic shortcut that makes people feel comfortable buying even into a tsunami of selling. And those two were ServiceNow and Mark Zuckerberg's Meta Platforms. They both blew away the numbers and gave you super forecasts. Interestingly enough, both companies are using AI powered by the latest and greatest of NVIDIA's chips. Meta, in particular, told a great story about how it can use AI to design and ad programs that are fantastic with a great return on investment for advertisers. That's an unbeatable combo. One drug company, Eli Lilly, gave you the best beat and raised quarter of the entire season, and that's thanks to the GLP-1 weight loss drug. Coca-Cola delivered a nice set of numbers, conservative beat, worth owning. Aerospace shine, GE Aerospace, followed by RTX, and then Howmet. We call that How I Met My Mother, but it happens to be a company that designs screws, fasteners, they call them, for planes. Two simple industrials made the cut. Parker Hannifin, it was very nice. And Eaton trounced the numbers by doing prosaic things. The kind of things industrials do. And Uber delivered an incredible quarter, showing that people are still going places and doing things. That's it, though. Oh, and sure, we can throw in Walmart now, but it's really too late. The buying opportunity is probably over. The bottom line on this incredibly important story that occurred over the last 2 weeks, there will be other buying opportunities in the future, other crazy sell-offs. But let's remember that very often these market meltdowns are driven by nothing. What happened 2 weeks ago was pure market mechanics, nothing to do with the fundamentals. So keep that possibility in mind the next time the averages get clubbed. It might be the opportunity you've been waiting for to do some buying. Why don't we start the calls with Peter in Florida? Please, Peter.
Hi, Jim. Peter in Florida. One question, if I may.
Sure.
AT&T, let it go or should I stay?
Let it go. There's a lot of better opportunities, including, by the way, T-Mobile, which is really a horse. Why don't we go to Greg in Tennessee while we're at it? Greg.
Good day, Mr. Cramer. It's a pleasure to talk to you.
Right back at you.
About 7 months ago, I bought a stock in what I thought was solid and consistently profitable company, and it's been terrible. It feels like I've got another Intel on my hands, and I'm down about 25%. Do you think it's time to sell to cut my losses or hang on to Nucor?
Oh, no, don't sell Nucor. Okay, look, Nucor is in the end, a cyclical company. We sometimes want these big steel companies to be something other than what they can be. In the end, they are still tied into the earnings cycle. They're still tied into any downturn. But when the Fed starts cutting rates, the first stock people are going to reach for, including me for my Travel Trust, will be Nucor. So please do not sell the stock. All right, look, you have to remember that very often the market meltdowns we get are caused by nothing. What happened 2 weeks ago was purely market mechanics. All the stories were wrong. So keep that in mind the next time we get a sell-off. It's often based on nothing. Oh, man, buddy, tonight, 2 years since the implementation of the Inflation Reduction Act. How is Jacobs Engineering faring? I'm going to talk to the CEO after earnings. Then Walmart beat on top and the bottom line and hiked its full-year guidance, as I just mentioned, citing healthy consumers. So could it be a sign of good things to come? I'm getting into the retail details. Plus, I'm eyeing an under-the-radar housing play that you told me about and telling you, maybe it'll be worth buying, maybe not. I'm turning into homework. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Lately, we've been so focused on the Federal Reserve that it feels like we've forgotten some big government-mandated trends, like the stunning amount of money the Biden administration has earmarked for infrastructure spending. Even a year ago at this time, Wall Street was eagerly searching for infrastructure winners that could feed at the federal trough, so to speak. I don't think anything's changed here, but the stocks have lost the excitement luster. Take Jacobs Solutions. It's an engineering construction services firm that stands to be a big winner from all this infrastructure spending, especially after they spin off their critical mission solutions and cyber and intelligence businesses to Amentum by the end of next month. So it's almost here. When Jacobs reported last week, even though the headline numbers were mixed, their backlog, which is where I'm focused on, was terrific. So let's take a close look with Bob Bragada. He is the CEO of Jacobs Solutions. To learn more, Mr. Bragada, welcome back to Mad Money.
Jim, always great to be here.
All right, so Bob, we're getting closer and closer, but fill our viewers in, because when we saw you last time, let's say it was in its infancy, but now we're really about to get the pure play that a lot of people want.
We're right there, Jim. I think last time we spoke, it was in December.
Yes.
And we had a long road ahead of us.
Right.
But thanks to a great team and working with all of our folks, we're right there. We've gotten the regulatory approvals almost, and by the second half of September, we'll be on our way.
All right. So what will RemainCo look like?
RemainCo is going to be a very focused business on infrastructure and advanced facilities. We also have PA Consulting, which we have a majority investment in,
right,
and does front-end consulting and advisory on infrastructure-type work. So the end-to-end life cycle is really what we're going to be focused in on.
Okay, so help me here. This morning, my partner David Faber turned to me and he goes, Jim, none of the money's been allocated yet for some of these programs. Like taking the chips. I know you're excited about the chips, but it hasn't even come out yet. Where are we really in all the IRA and chips money in terms of how far along the whole process is?
So maybe we'll go through each.
Yes, please do.
On IIJ, which is really focused in on infrastructure,
right,
we're probably 60% appropriated, 30% spent. And so the money has been flowing to the states. Remember, there was two parts. There was a top-up on the formulaic transportation type spending, and then there were grant money. And so the grant money has been flowing, as well as the top-ups on the formula-based work. So that's been going, and we've seen that in our pipeline.
Right, and you have a lot of that.
We have a good amount of it.
Right.
In our pipeline, so double-digit growth in the top line in water, as well as in advanced facilities, which is kind of the segue to chips. Right. The CHIPS Act, remember, those companies had already started those fabs and then made applications for the monies.
Okay.
So whether they've received it or not, I think that's debatable. But those fabs and the kind of the chip manufacturing infrastructure around the country is well underway.
Now, let's talk about one of those. there's a question that was asked of you in the conference call about Intel. And Intel, this morning we learned that SoftBank didn't want to partner with Intel because they didn't feel they were so-called up to snuff. With the kind of idea that maybe they've taken on too much and they may not have necessarily the money to do it all. Is there a way to be sure that Jacobs is never caught not getting paid?
No, especially not with Intel. Intel's been a long-time client of ours for over 40 years. Resilient company, and yes, Jim, some things that are in the news right now with regards to where they are. We're bullish. It was a bold move that Pat made back in 21 about turning into a foundry. And a lot of that infrastructure is well underway. So we're comfortable there.
And you feel good about the Brookfield Apollo tie-up, that just in case it's kind of like belt and suspenders, right?
I think it'll still be there. Okay. I think what's even more exciting when you think about kind of the chip industry in the U.S. is what's happened with the others. If you look at Micron or some of the other Asian manufacturers that have come here, those fabs are well underway and producing that infrastructure that we desperately need.
Are you doing the Taiwan Semi in Arizona?
We're not.
No, because that's a gigantic one.
It
Holy
is.
cow. I'm conscious that some of these are, there's a lot of them in New York State. I mean, they're kind of everywhere.
They are, and so not just in logic, but in memory as well.
Right.
And so this is kind of high bandwidth memory. I'll give you an example.
Which is Micron specialty.
It's Micron specialty. And if you look at an AI chip, there's probably more Micron silicon on that chip than there is NVIDIA silicon. Yeah, so it just tells you the power of Micron.
So you spend a lot of time with Sanjay Mehrotra, figuring out what to do next?
I've met him. Great person.
Yeah, he really is. He's dynamite. Now, speaking of dynamite, you know we like what David Ricks is up to with GOP-1. And what I don't think people understand, particularly the people who believe that everybody who challenges them is going to be a winner, will you please tell people how hard those places are to build?
They are extremely difficult.
And why?
The complexity inside the facility. You look at the outside in, Jim, this looks like a warehouse.
Right.
You go inside, and this is a very sophisticated arrangement of vessels, reactors, heat exchangers, and the layout is important. So that manufacturing layout is extremely important when you're going from a bench scale therapy to commercial production.
Well, then it is like, in that sense, a Micron high bandwidth foundry.
It very much so. That's why Jacobs is in both.
Right, and you strive for actually you're in that niche of the most complicated jobs, right? You're not just building simple warehouses.
No, I'll give you an example in life sciences, Jim. We only work with those tier 1 clients who are advancing science and therapies beyond ever.
Well, I've got to tell you, I think that that's a great gating factor. One of the reasons why I wanted to have Jacobs, the company, is there just not a lot of other companies. I mean, you don't have to say the names, but how many people can really bid on these very complex jobs?
To say a handful, that'd be a lot. A couple, globally.
Really?
At that scale and that type of speed, only a few.
So how often do you follow around a company like it? So Lilly will build one here. They might want to have to build one in Germany, maybe build one even over in Asia. Are you a leg up on them if you've already do it here?
We go with that client all over the world.
Oh, that's fantastic.
Our life sciences clients procure centrally and deploy capital globally, and we're a global company. We go with them.
That's fantastic. Now, do you think about what would happen if they changed the White House? Are you more focused on Congress? Are you focused on the bills that are now law that you don't even have to worry necessarily? Or is it you have to keep an eye on it?
It's probably more the latter. This is law. It was bipartisan support for these stimulus acts, and all states are benefiting. This isn't red states or blue states. It's the United States that are benefiting from this.
Okay, so just to pin things down, if I buy Jacobs now, I get it's a little convoluted. If I wait a couple of months, when I buy Jacobs, I'll get all the things we just talked about, correct?
You would, but also, Jim, if you buy now, you get that with the added benefit of Amentum. Which is going to be the merged company that's coming out. They just had their capital markets day this week.
But they'll have their own different CEO.
They'll have their different CEO, different ticker, but with a board of directors and exec chair, a majority of the board of directors in the exec chair and the COO that came from Jacobs.
Well, I'll tell you, it's a very exciting time. Everything that you told me a few years ago has come true. You urged patience on my part, and I have adopted that patient attitude. But it's very exciting what you're doing.
Thank you, Jim.
Very exciting.
Thank you.
That's Bob Pragada. He's the CEO of Jacobs. It's letter J, guys. Jacobs Solutions. Mad Money will be back after the break.
Coming up, what's driven Walmart to record highs? Cramer breaks down the earnings report that's brought heat to the streets. Next.
This earnings season, we've seen a lot of hand-wringing about the state of the consumer and the state of retail. Even Amazon gave us cautious guidance, but not all retailers are in the same boat. This morning, Walmart proved that when you offer shoppers great value, they'll keep showing up. That's how Walmart managed to report a glorious quarter. They delivered 4.2% same-store sales growth. Wall Street was only looking for 3.4%, with the vast bulk of that coming from transaction growth, not higher prices, which is not what you want. You don't want this number to be made by inflation. When you keep prices at a reasonable level, the traffic takes care of itself. This is what allowed Walmart to post a sizable revenue beat with expanding gross margins and a 2-cent earnings beat off a 65-cent basis. Both the core Walmart business and Sam's Club put up just fantastic numbers in the U.S. Walmart International had softer sales, but its operating income came in much higher than expected. Management also had good things to say about Flipkart, their e-commerce subsidiary that's a major player in India. In fact, this company's even doing well in China with strong membership trends and especially strong performance from Sam's Club over there. Everybody else is getting crushed by the China's weak economy, but not Walmart. What else? All right, now here's a stunner. Walmart put up 21% e-commerce growth worldwide, driven by store-fulfilled pickup and delivery. Their nascent advertising business, the margins here are insane, grew by 26% globally, and their loyalty program, Walmart Plus, had double-digit membership growth. Best of all, unlike so many other retailers, Walmart raised its full-year forecast across the board. They raised the revenue growth outlook from 3 to 4% range to the 3.75 to 4.75% range. It might not sound like much to you, but when you're dealing with low to mid-single-digit growth, that is meaningful improvement. They also raised their full-year earnings per share outlook by 9 cents per share at the midpoint. Remember, Walmart only beat by 2 cents this quarter, so the 7 cents, they're coming for the rest of the year. So many companies just won't raise. These guys did. In fact, the strength's really coming from the fourth quarter because their earnings guidance for the current quarter came in a tad light. That little fly in the ointment wasn't enough to prevent the stock from shooting up nearly 7% today. This is a gigantic company, people. And by the way, not a tech company, although it's got a lot of tech. Why did this happen? Because as strong as the numbers were, the conference call was heavenly. It was fantastic. Just listen to what Walmart CEO Doug McMillon had to say. I'm going to quote. So far, we aren't experiencing a weaker consumer overall. Boom! Very encouraging. He goes on to say, around the world, our customers and members continue to want 4 things. They want value. They want a broad assortment of items and services. They want a convenient and enjoyable experience buying them. And they want to do business with a company they trust. Walmart checks all 4 boxes.
That was easy.
They basically laid out a playbook for how a retailer can thrive in this environment. I don't think they should help. Maybe other companies can't do it because right there it's like, here, you want to take us on? This is what you do. I was pleasantly surprised when McMillan stressed not just price, but also convenience. Gym management used the word convenience 11 different times on the conference call. While everybody knows Walmart has incredible prices, which should theoretically be enough to drive traffic at a time when consumers have less money to spend, thanks to years of inflation and softening economy, these guys made it clear that convenience is part of the secret sauce that keeps people coming back. That makes sense to me. Remember, even though we've got a very value-conscious consumer, she keeps paying up for various online delivery services, even though it's much cheaper to take out. DoorDash, Uber Eats, and Instacart are all doing well because these days people value their time even more than they value their money. McMillan went into more detail with this theme when he got a question from BMO analyst Kelly Banya during the Q&A session of today's earnings call. She wanted more color on how Walmart's taking tons of market share thanks to gains with, get this, upper-income households. Historically, that really hasn't been their demographic. Now, I have to tell you, my daughter and I, both my kids, we love shopping at Walmart. But we tend to assume most rich people wouldn't deign to set foot in one of these stores, even though I got to tell you, they are just dynamite. However, McMillan insisted value matters to everyone. Listen to this quote. As it relates to higher income people, they can buy more discretionary goods and they can pay more for convenience, and we're offering all of it, end quote. That's exactly how we feel when we go. Now, think online delivery fueled by Walmart Plus memberships. Throw in the new remodels, and he thinks he can keep taking share with higher income consumers. He's right. If you go there, you'll buy the stock. Now, there was a lot of interesting stuff on the call. We're talking about the biggest retailer in the world here, so they have some keen insights, even where you'd least expect it. For example, generative AI. It came up. McMillan said Walmart's using it to improve their product catalog. As he explains, and I quote, the quality of the data in our catalog affects nearly everything we do, from helping customers find and buy what they're looking for, to how we store inventory in the network, to delivering orders, end quote. According to him, the company would have needed to hire nearly 100 times as many people to handle all this data in the same amount of time without generative AI. Well, there you are. That's the best use case I've heard yet. It's either that or it would have taken much longer to get organized. That's the other way you look at it. So who says generative AI doesn't have a use case? It just saved Walmart a fortune. I keep waiting for a major grocer to mention the hit that the food business has to be taking, right from the GLP-1s, has to. The weight loss drugs that eliminate cravings. Walmart's the nation's largest grocer, and they did actually mention GLP-1s on the conference call, but not in the way I guess I was looking for. Instead, we learned that their health and wellness business contributed to the strong same-store sales, primarily thanks to sales of GLP-1 drugs. They'll acknowledge it on the pharmacy side, but we'd still like to know more about what it's doing to the grocery side of the business. Right now, they say it has not been negatively impacted. Overall, this was a very strong set of numbers, and it came just a couple of hours before the better-than-expected July retail sales report. That combination was a huge driver of today's remarkable rally. When Walmart crossed these numbers, I said, no, not today, Satan. This is going to be a good one. But the bottom line, don't make the mistake of assuming that Walmart's results give you some kind of generic read on the consumer. You can't just extrapolate from the best operator in the industry to everyone else. This quarter is a testament to the fact that Walmart's management keeps doing an excellent job. I hope the rest of retail can come close. But when it comes to brick and mortar, with the sole exception of Costco, Walmart's in a league of its own. And you know what? I think it's got more room to run. Why don't we take calls? Why don't we go to Mike in Illinois? Mike.
Jim, how are you?
I'm doing well, Mike. How about you?
I'm great. I have a nice position in TJX, and I'm wondering if I should add to it before its earnings come out on the 21st.
Okay, so that's a dicey question because we're putting a little gun to my head, and I say take the gun away. TJX historically has not performed well around earnings. So what I would do, it was up very nicely today. It was up 2.5%. I would wait till after to buy because it tends to collapse after they're very conservative. People keep expecting them to say great things. They don't play it that way. Buy it after, not before. How about we go to Michael in Tennessee, please? Michael.
Hey, Jim. Booyah. This is
Booyah.
Michael from Nashville, Tennessee.
Oh, I love that city.
Yeah, it's great. Born and raised.
Oh,
hey,
good
Jim,
for you.
my question is in regards to Cava. The company has plans to have 1,000 stores open by 2032. What are your thoughts on Cava's growth strategy compared to what
I love Cava's.
been able to do?
No, Cava's real. It's the best new concept. I like it. It was down 10 points last week when we recommended, so I don't know. It's all the way back up. Why don't you give it a rest before you jump in? All right. The quarter Walmart just delivered is a testament to the great job from its management team. They are really good. I hope the rest of retail can follow along, but besides Costco, which we own for the Charitable Trust, Walmart really is in a league of its own. Hey, but we've got a lot of man today. I'm eyeing one under-the-radar housing player that I first learned from you, Cramer. Then, what's in and what's out in this market? After volatile action in the tech sector, I'm going to reveal what to watch. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Whenever you call me and ask about a company that I don't know or haven't been following, I always promise to do some homework and then circle back later with a more informed opinion. As much as I love talking about my own favorite stocks, especially the ones we own for the Charitable Trust for the CNBC Investing Club, at the end of the day, the show is about helping you become a better investor, which means I need to be able to address the stocks that you actually care about. Otherwise, what's the point? So let's catch up on some summer reading. Back on July 29th, Jeff in Connecticut stumped me with a company called 4-Star Group. That's FOR for all you home gamers. I said I'd get back to him. I did not know this company. It's an outfit based in Arlington, Texas. It represents a key link in the home building food chain. See, 4-Star is what's known as a residential lot development company, one that operates in 60 markets across 24 states. Their business is pretty straightforward. They acquire entitled real estate, then develop that land into finished residential lots by building the necessary infrastructure. They then flip those lots to the home builders for a nice profit. Home builders love this setup because it allows them to keep less land on their balance sheets. In fact, D.R. Horton, the nation's largest home builder, liked Forestar so much that they got into a bidding war for it back in 2017. They ended up buying a 75% stake in the business. At this point, that stake's down to 62% because Forestar's issued new stock. But it's still a subsidiary of D.R. Horton that happens to be publicly traded. More on the subsidiary status in a second. Look, you know what? Frankly, I hesitate to endorse this kind of situation. I think to myself, why would I own the subsidiary when you can just own the parent, which controls its destiny? But man, the D.R. Horton relationship has been great for Forestar. From 2018 through 2023, the company saw a 1,000% increase in lots sold. Their revenue's grown from less than $200 million in 2017 to $1.44 billion last year. Their earnings have roughly tripled over the same period. However, Forestar's stock pretty much flatlined until the market-wide bottom in the fall of 2022, at which point it finally took off. Remember, when the Fed started rapidly raising interest rates, Wall Street assumed that everything connected to housing was toast. In reality, as you know from watching the show, the housing shortage in this country is so severe that even sky-high mortgage rates didn't start doing much damage to home sales until pretty recently. At the same time, existing homeowners don't want to sell because of the so-called golden handcuffs. They locked in ultra-low mortgage rates when the Fed was in easy money mode, and they don't want to trade those mortgages for much more expensive mortgages they need to buy another house in this environment. All right, that's been great for home builders because they're basically the only real source of additional supply, the only inventory around. It's given them tremendous pricing power, which they have, and they have great gross margins. And that strength flows down the home building food chain to Forestar, which saw its stock near roughly quadruple from the lows in October 2022 to its highs this past March, quadruple, before cooling off a bit in the last few months. Now, this thing peaked at around $40 in the spring, and now it's closer to just under $30. Now, you might think I'd be all over this one because I've spent so much time recommending the building suppliers and tool makers and even lumber companies lately in anticipation of some Fed rate cuts that should provide a huge boost to the home builders. If mortgage rates come down and buyers get more aggressive, the home builders will need to buy more land from companies like Forestar, right? Not so fast. Remember the golden handcuffs, something Home Depot mentioned earlier this week that I had never used the term before? We've got all these existing homeowners who won't sell until mortgage rates come down. But if you think the Fed's going to start cutting rates, that unlocks the golden handcuffs. It means existing homeowners will finally start listing their houses, which is bad news for now for like Forestar. More importantly, it's not like these guys are doing well at the moment. Forestar disappointed badly when it reported mid-July, thanks to a nasty 15% decline in lot deliveries, much worse than expected, by the way. Sales were down 14%, earnings down 18%, both missing the estimates by a mile. Management also cut their full-year closings forecast. So demand's clearly evaporating here. But Forestar's got 102,100 lots. That's right, 102,100, up 40% year over year, meaning they're stuck with tons of excess real estate. Now, it doesn't help that the company's a little too concentrated in some pretty wobbly housing markets. More than 58,000 of those lots are in Texas, which is peaked for the most part, and Florida, which I think is definitely peaked. For the last few years, it's been fabulous as both states have had tons of immigration post-COVID, but they're now starting to struggle a bit with lots of new supply coming online in those markets. So you have to expect less new construction, and that means Forestar should sell fewer lots. You know what? I also worry about this Forestar relationship with its parent company, D.R. Horton. Sure, this partnership has worked well for them so far, but at the end of the day, D.R. Horton has a controlling interest in Forestar. When your biggest customer is also your biggest shareholder, you have a problem. When it comes down to it, Horton will do what's best for Horton shareholders, not Forestar shareholders. In short, if you own this one, D.R. Horton has the wheel, you're just a passenger. Again, there are very few situations where it's worth owning someone else's publicly traded subsidiary. If you like Forestar's business and you believe, as I do, that the housing complex will indeed get a huge boost once the Fed starts cutting rates, well, then let's think about this. Why wouldn't you just buy D.R. Horton instead? You get Forestar, you get a quality home builder, and most importantly, you're buying shares in a company that's actually in control of its own destiny. Let me put it this way. Since D.R. Horton acquired a controlling interest in Forestar Group back on October 5th of 2017, Horton's stock is up 332%. Forestar's? How about 80%? Horton's dramatically outperformed both the S&P 500 and the S&P Home Builders ETF. It's a really good company. Forestar's dramatically underperformed both benchmarks. In fact, whether you're looking at the last 3 years or 5 years, 1 year, doesn't matter. D.R. Horton significantly outperformed Forestar in every single time frame. Same goes for 2024. Horton's up more than 15% for the year, and Forestar stock is down more than 10%. So here's the bottom line. When you have a choice between a parent company and its publicly traded subsidiary, you almost are always better off with the parent. I'm not that sanguine about Forestar's core business, even once the Fed starts cutting rates. But even if I love this company, I'd still tell you just bet on D.R. Horton instead, because Horton owns 62% of Forestar, which means they are calling all the shots. Mad Money's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the light round. Everybody, that's what we call rapid fire. Same minutes talk. I tell you to buy, sell, just figure out another caller. Stock questions at a time. My staff prepares to go fight. Play in this. And then the lightning round is over. Are you ready, Ski Daddy? Time for the light round. Let's start from Cody in Kansas. Cody.
Hey, Jim, it's Cody Reynolds calling in from Tonganoxie, Kansas, not too far away from Kansas City. And I will say I love myself some barbecue, and Arthur's is overplayed. Beamer's all the way.
I think you're right, actually. When we were out there, it was -9, so I couldn't feel my mouth anyway. What's happening?
I want to hear your thoughts on Snowflake. They just announced a partnership with TransUnion last week.
Yeah, the latest feedback I'm getting about Snowflake is that they have some difficulties. They're challenged by a couple of companies. It's kind of like the long knives are out for those guys right now. I think I'm going to hold off from recommending it. Let's go to Sandeep in California. Sandeep.
Hi, Jim. Booyah.
Booyah.
Thank you for helping us, all of us. You're doing a great job, Jim.
Oh, thank you. Thank you very much.
Yeah, I'm curious about Royalty Pharma, RPRX.
You know what? I always thought there was going to be more to this stock than there has been. It's really been a bit of a bust. I feel badly. I thought it was going to constantly have a bigger yield, a bigger dividend, and it hasn't worked out. And as far as I'm concerned, it's just a so-so situation. Let's go to Arlene in Texas. Arlene.
Hi, Jim. Long-time admirer, first-time caller.
Thank you.
So the stock I'm curious about is Coors. What are your thoughts about that?
Now, there's two Coors. There's the one I like, which is TAP, T-A-P, but that's a joke. And then there's Core Scientific. And Core Scientific is a very overvalued situation, principally because of the fact that it's never made any money. But it is another play on crypto. If you like crypto, buy crypto. Let's go to Bobby in Louisiana. Bobby.
Hey, Jim.
Bobby.
With automobile prices coming down and potential interest rates cuts approaching, what's your opinion on Ally Financial?
Buy. Really simple. You laid the case out well. You're absolutely right. Let's go to Vince in Nevada. Vince.
Hey, booyah, Jimbo. My name is Vince from Vegas. They call me Vegas Vinny. How are you today?
I'm good, Vegas Vinny. How are you?
Good. I'm jamming, Jimmy. Let's talk some stock. NCLH, Norwegian Cruise Line. Been in it for 2 years. The dollar cost averages out $20 a share. Every time quarterlies come out, they smash Wall Street's expectations. Most analysts say it's almost a $30 stock. Give me some good news, Jimbo.
Royal Caribbean. There's the good news, Jim and Vince from Vegas. Because I like Royal Caribbean because every time that stock comes down, there's like thousands of buyers come in. Every time the Norwegian comes down, nobody cares. Let's go to Eli in Connecticut. Eli.
Hey, Jim. Love your show. I'm a high schooler, new investor.
How do you like that?
For this, but I'm a diehard Giants fan. I've had Pfizer for a little while now. I like the 6% dividend, but it doesn't want to move higher. What are your thoughts?
Well, first of all, I think that when you gave away Saquon Dust, that was very kind. I never really saw that coming. I never knew we were such best friends. So it's good. Thank you very much. Secondarily, Pfizer is kind of like who we gave you. Who did we give you? I forget. That's right. Pfizer has a 5% yield. It's got some interesting drugs. And I'm sorry, but it's, look, you bought one guy for $60 million, and he turned out to be a penny stock. Let's go to Ross in Arizona. Ross.
Booyah, Jimmy Jill.
Yo, man, what's shaking?
Not too much. So with more than 500 robo-taxis already on the road and plans to double that by the end of the year, strong cash flows, and a forward PE in the mid-single digits, what are your thoughts on Baidu?
Right, see, Baidu, the problem with Baidu is if it were in any of the other 172 countries in the world, I'd probably say buy it. But it happens to be right now in a communist regime that is pretending to be capitalist. They are communists. I don't want to buy anything from the communists. They have historically been people you don't want to buy from. Let's go to Raymond in Kansas. Raymond.
Hey, how are you doing, Jim?
Oh, Raymond, I'm real dynamite. How about you?
I'm doing great. It's Raymond like everybody loves Raymond. But
okay,
the reason I'm calling is I want to know about the Chinese stock, the flying cars, XP.
Yeah, it's about time to buy a flying car stock from People's Republic of China. I've been thinking about it, and I said, there's nothing like buying a flying car from President Xi, but maybe I'll take a pass. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
It's hard to keep track of the Wall Street fashion show. Up until today, for the last 3 weeks, we hated the data center story. Previously, one of the hottest trends around. We heard it was big hat, no cattle. We all felt fooled by artificial intelligence and the machines housed in the data centers that probably aren't even used, right? A lot of dust gathering there. Suddenly, though, out of nowhere, the data center, it's back! NVIDIA stock is running. Supermicro, which hurt the story so badly that last quarter is now steaming full speed ahead. When a stock that brought down an entire group rallies this hard, you have to recognize it and you must exploit it. All aboard! What changed the dynamic here? Why did the data center become fashionable again? Hard to say. Hey, maybe it was Cisco talking about how strong artificial intelligence is. That was a solid quarter Cisco just gave us with a lot of AI bells and whistles. Maybe it's the possibility that Japanese giant SoftBank is going to team up with, I don't know, maybe an AMD or Broadcom to challenge NVIDIA. Don't laugh. Today, the FT, Financial Times, said that SoftBank wanted to team up with Intel to challenge NVIDIA, but the deal fell apart because apparently Intel couldn't deliver. And it said, I believe it. Very hard for Intel to deliver such a heinous balance sheet. AMD and Broadcom would be worthy standards, though. It's purely speculative. But so was the story in some outfit called The Information that crushed the AI stocks 2 weeks ago by claiming that NVIDIA's latest high-end chip, Blackwell, was significantly delayed and would therefore cause a setback for many of the tech titans. Looking back, that seems more like it's from the misinformation. Now, we'll hear from NVIDIA on the 28th. The company's in its quiet period, can't currently defend itself. But I'll tell you, there's been a subtle shift against the negative narrative against AI, a shift that should allow NVIDIA to run right into the quarter. What hasn't fully come back yet? Okay, I got them. The ancillary plays, like Eaton, which makes so much of the electronics and power equipment for the data center, as does Vertiv. Let's not forget Cummins. We had them on recently. They make backup power systems for these warehouses full of servers. I am partial to Eaton. We own it for the Chapel Trust because it's figured in so many mega trends. The data center is only one of them. But they all work. Same goes for Dell, which links the NVIDIA chips to the clients themselves. It's become a very hot stock again, and it can still go higher. How do we know that business is still booming here? Well, why don't we just listen to Jonathan Gray? He's the president and COO of Blackstone, the massive private equity firm that owns a gigantic data center company called QTS. John was with us on Squawk on the Street earlier this week. He told a tale of incredible growth. It's not running out any room whatsoever. Early innings. There's so much data that's needed to the point where building these data centers will be a huge, profitable business for a very, very long time. At the end of the day, artificial intelligence and its accoutrements keep flitting in and out of style on Wall Street. Each time it's pronounced dead. Each time some wag points out that the gains in NVIDIA are absurd and must be rolled back. Each time you get a giant snapback like we're seeing right now. Maybe, just maybe, when the group sells off again, we should remember that the data center is not some fleeting, finite story. It's actually more like the greatest story ever told. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.